Hello and welcome. Today, we're going to trace the incredible journey of money. I mean, think about it. We've gone from a simple promise written on a piece of paper to the invisible digital signals that pretty much run our entire world. It's a fascinating story about how trust got written down, then digitized, and finally made instantaneous. So let's start with a question. What could a dusty 100-year-old IOU possibly have in common with that coffee you just bought with the tap of your phone? I mean, they seem like they're from different planets, right? Well, believe it or not, they're built on the exact same incredibly powerful idea, a trusted promise to pay. And to really understand how we got to our digital world, we've got to go back to the beginning. We need to look at the foundation, those physical documents that for centuries were the next best thing to actual cash. So let's follow money's paper trail. Okay, so the absolute cornerstone of all this, the concept that really made modern business possible, is something called a negotiable instrument. Now, don't let the fancy name fool you. It's basically an IOU, but with superpowers. It wasn't just a promise between two people, it was a legally recognized promise that you could actually transfer to someone else. It turned a simple promise into something that could be passed around, almost like cash itself. It was a promise with some serious legal muscle behind it. And these instruments came in three main flavors. The simplest is the promissory note. That's a straight-up, I promise to pay you. Super simple. But the other two, the bill of exchange and the check, they're a little different. They aren't promises, they're orders. The person writing it, the drawer, isn't promising to pay. Nope. They are ordering someone else, the drawee, to pay a third person. And in the case of a check, that someone else is always a bank. Now, that tiny shift from a promise to an order, that was a complete game changer for commerce. It made everything so much more flexible. But here's the thing. A promise on paper is, well, it's just paper, right? It's only valuable if you trust that the person who wrote it is actually good for the money. And this is exactly where banks step into the picture. They're not just places to store money. They became masters of lending. You could almost call it the art of renting out money. It's how they take all those deposits just sitting there and turn them into active fuel for the economy. And when you get right down to it, bank lending really boils down to two basic types. You've got secured loans on one side. These are backed by a real physical asset that the bank can take if you stop paying. For them, that's pretty low risk. But on the other side, you've got unsecured loans. These are based on nothing more than your word and your financial reputation. There's no backup asset, which means, you guessed it, way higher risk for the bank. So what is this backup asset, this collateral? Well, it can be almost anything that has real value. We're talking about the obvious stuff like a house for a home loan or a car for a vehicle loan, but it can also be things you might not think of, like gold, fixed deposits, even life insurance policies. It's the security that makes a secured loan, well, secure. And this brings us to the single most important rule in all of lending. You need to remember this one. Risk determines the price. It's that simple. The more risk a bank feels it's taking by lending you money, the more it's going to cost you. And that cost, of course, is the interest rate.
And the difference in price is staggering. Just look at this. A secured home loan, which is a pretty safe bet for a bank, might cost you somewhere between, say, 8 and 13% in interest. But an unsecured loan, like your credit card debt, with zero collateral to back it up, the risk for the bank is through the roof. So that rate can leap to a jaw-dropping 48%. That right there is the price of risk made visible.
Now, this paper system worked, but can you imagine the logistical nightmare? All these checks, all these notes, all had to be physically moved from place to place. By truck, by train, by plane. It was incredibly slow, it was expensive, and of course, it was risky. Things got lost. This giant inefficiency was really the spark that lit the fire for the next great leap, the move from paper to pixels. And that leap came in the form of something called the check truncation system, or CTS. The idea behind it is actually genius in its simplicity. Instead of putting a check in a truck and driving it across the country, banks just started taking a high-quality digital picture of it. The physical paper's journey was truncated, or cut short, right there. And that electronic image was sent for clearing instead. It's literally the difference between mailing a letter and emailing a photo. So the process became beautifully simple. You deposit your check at your bank, and that's it. The journey for that physical piece of paper is over. Your bank just snaps its digital ghost, sends that image through the clearinghouse, and the funds get settled. By keeping the physical check in one place, the entire system got so much faster and a whole lot more secure.
But, CTS was really just the start, because even taking a picture of a check still involves a check. It got people thinking, wait a minute, why do we need the paper at all? And this is where modern electronic payments just completely change the game.
So let me introduce you to the unsung hero of modern banking, the Electronic Clearing Service, or ECS. This is the workhorse system that's designed to handle all those boring, repetitive, but absolutely essential payments in our lives. It's the engine that powers things like paying salaries or collecting bills, all without a single piece of paper changing hands. And ECS is brilliant because it really just works in two simple directions: push and pull. You got ECS credit, which pushes money out from one account to many different accounts. Think of a company paying salaries to thousands of employees all at once. Then you've got ECS debit, which does the exact opposite. It pulls money in from many different accounts into a single one. That's how your utility company collects payments from everybody every month. It's a simple, powerful push and pull system that runs silently in the background. All right, so we've journeyed from a signature on a piece of paper to an invisible digital signal. But what's the big deal? Why should we really care about this whole evolution? What does it actually mean for us and for the economy as a whole? Well, the impact is absolutely massive. First off, speed. Transactions now clear in minutes, not days or weeks. Then there's convenience. Our bank is literally in our pocket now. Security is a huge one too. So much less risk of physical theft or fraud. It's also incredibly efficient, which lowers costs for both banks and businesses. And when you put it all together, when money can move this quickly and this easily, it acts like a supercharger for economic growth. And this whole journey brings us to a final, pretty mind-bending question. We started with a physical, tangible promise to pay written on paper. But now, when money is just a stream of data, just ones and zeros flying through the system, where is that promise? What does it actually mean anymore? It really forces us to think about the future of trust, of value, and of money itself in a world that's becoming completely digital. Something to think about. Thanks so much for joining me.